the Financial Survival Network. Now more than ever, the Financial Survival Network.
And welcome. You are listening to and watching Financial Survival Network. I'm your host, Kerry Lutz. Person you're about to hear from, Michael Markowski, has predicted all three major crashes since 2007, particularly the crash of September 2007. All of it is documented and verifiable, and we can always provide that if you'd like. You find him at alphatack.com. That's ALPHATACK.com. And really pleased to bring you this guest, Michael. We've talked a lot on the phone, through email. It's great to have you on the show. And hey, so you have a record of predicting these crashes. Do we have one coming up now?
Well, I want to actually what's happened is I'm predicting a couple of significant things to occur. I'm predicting a 69% from the peak to the trough decline for the S&P 500. And I'm predicting that the third U.S. Great Depression will begin by the end of this year for the United States. The first Great Depression since 1929. And the first and second were 1920 and 1929. So I'm predicting those are my two major predictions, and I made those last June. Yeah.
Define a Great Depression. I mean, there are like different people have different views on this.
Well, what I want to state, Kerry, is that every prediction that I've made, and I'd like to show you my prediction. So every prediction I've made is based upon the data. Mm-hmm. Okay, my research of data.
Okay, well, why don't you share the screen? But when we say a Great Depression,
well, we're going to get into that. I'm saying to you, these are my two major predictions. But for a Great Depression to occur, there has to be a couple of ingredients, and the major ingredient is a 45% plus decline for the stock market from the peak and trough, from the peak to the trough. Mm-hmm. Okay, so the depression's not going to happen. Okay, will not start until the stock market has declined by 45% from the January 22 high. Okay, that's what I'm saying.
Gotcha.
So I'm saying, if I wasn't predicting a 69% decline for the S&P 500, I wouldn't predict that a Great Depression's coming. I've studied both of the past two Great Depressions extensively.
And this is going to be global in nature, this depression?
Yes, this depression will be global. The last one affected the United States. This one is going to affect the entire world, is what this one's going to do. Now, you see this day of reckoning, right, on my
we see it.
Screen? Okay. So what I want to have to explain to you what I do, and this will in a nutshell, I'm different than any other predictor in the market, and that I don't have an opinion. Somebody asked me last year, what did I think about Bitcoin? I said, I don't know anything about Bitcoin because, I don't have any data that would tell me what about it, okay? Why it's risky, whatever. So this is a good example. Okay, so this is my article that I wrote in September of 2007. And this is what I said in this Equities Magazine article. I said, I believe that there will be a day of reckoning. It will be sooner rather than later, and that day will be ugly for the 5 largest brokers. Okay, now at that time, here's all the brokers below. You can see their price. Here's their share prices. Below, you can see that their share prices were much Here's all their share prices. Okay, price 193, Goldman Sachs, Merrill Lynch 78, Bear Stearns 121, Morgan Stanley, AG Edwards. So the reason why I predicted this is that I'm an expert, and I've developed expertise on cash flow, on operating cash flow for public companies. And how did that happen? Well, what happened is in 2001, in the summer of 2001, Enron hit an all-time high, the share price. And by December of 2001, 6 months later, by December of 2001, it filed for bankruptcy. Now, the company also reported record earnings per share in the quarter for that quarter of June 30, 2001. So what I did is I said, how could that be? You had 27 Wall Street buy analysts telling everybody to buy it, and it files for bankruptcy when it's reporting record earnings? How's that possible? So I went in and did an autopsy on it, and I figured out what would have told me that this was going to happen. This collapse was going to occur for Enron. And what I found is that they had negative cash flow. Okay. So Enron was reported record earnings, but the cash flow from operations was negative. So I created an algorithm out of that, and I started predicting bankruptcies of major U.S. companies, and I predicted some very large bankruptcies, including Fleming Companies, which was the largest U.S. food distributor at the time out of Oklahoma City. And at that time, one of the big broker dealers, in fact, one of these guys was raising them $600 million at the time that I predicted they go bankrupt, and they went bankrupt within a year. Okay. The company paid a dividend on this New York Stock Exchange since 1935, the Fleming Companies. So you can see the negative cash flows, how bad it was for these brokers over here. You know, minus 42 for Lehman, 34, minus 34 for Morgan Stanley, minus 64 for Merrill Lynch, minus 58 for Bear Stearns. This one down here, AG Edwards, is just a placeholder to show you that not all brokers, create negative cash flow. And these brokers are right now generating positive cash flow. So the point is that enabled me to develop an algorithm that I used, and that algorithm identified all of these companies as having the exact same trade as Enron before it collapsed. All of them, except for AG Edwards. So that's really what I do. I research, I do deep research on empirical data, and then I create an algorithm out of it, and then I use that to predict the future. Okay. So that's how I make all my predictions. My crash prediction, my 69% decline prediction right now is based upon my research of the S&P 500's negative dividend yields dating back to 1871. And that's where that came from. And that's all data-based as well. And even my Great Depression prediction is based upon my research of the Federal Reserve's discount rate policies dating back to its inception in 1913. So everything that I do is data driven. I don't make a prediction unless I've got data to back me up. But we can get into that in subsequent. When you and I have talked about having me on a few times to really go over this stuff in detail. But what I'd like to go over with today is the secular markets.
Oh, and Michael, let me just interrupt. So we're going to have a link for you people listening on the audio and on YouTube. You can download these charts and review them yourself as Michael talks about them. And this is the first part of a 3-part series. Michael wants to explain 3 different avenues for the same result of a Great Depression and a major stock market crash.
Yeah, what I'm going to explain to tell everybody is there's 3 ways for I say, pick your poison. There's 3 ways for the S&P 500 to go down by a minimum of 45%. There's three ways that can happen, and I actually in each one of our interviews, I'll identify one of the ways.
Great.
And right, and that's one of the ingredients, the most important ingredient for a recession. Well, for a depression to occur, is you have to have a decline of 45% for the S&P 500. The depression will not occur without it. Okay, so that's a key ingredient. So I hope that when everybody goes through all of my interviews with you, they will understand they need to protect themselves. Okay, there's a serious debacle is coming, and I didn't know that at the time, but in fact, what I was predicting with these brokers was the Great Recession, because they caused the Great Recession, all of them, their collapses in September of 2008 caused the Great Recession, the 2008 Great Recession. So so let's go into now. I want to talk about secular markets, and I'm going to let me just switch. I'm going to stop sharing that one and start sharing another one. Let's see here. Yeah, secular. Okay. So this would be now, I predicted, let's not even get into that right now. Let's talk about this. Now, my screen might be too big. Can you see this, Kerry?
Yep, I see it. Yeah.
Okay. So I've got expertise in researching the markets are secular, and this is fascinating stuff. Since this is the chart of the Dow Jones from 1921 to 2021, 100 years, and the average, it's a 450% increase. That means the average gain is about 4.5% a year. And that's about the max that it can be, because of the stock market capitalization growth is capped to population. So if the population is growing, and it is probably at a 4.5% worldwide, the stock market over that period of time is going to grow at 4.5%, because you have more people eating Oreo cookies every year, more people drinking Coca-Cola every year. So your total long-term return on the market is tied to population growth. Now, in the meantime, during that period, that same period, as another look at that chart, what you'll have is periods of time with that market going up like that, where the market goes up sharply and then breaks down again, back up. So you see 1921 is a bull, what we call a bull market. A bull market is a secular market that moves up, and this market started moving up, and the secular bulls always begin at the bottom of secular bears, and secular bears always begin at the top of secular bulls. So you see this 21 bull to 1929 bear here. Market is going down. So we can see here now in 1949, it peaks here in 1929, comes down till 1949. Then it peaks, and then it comes back to 1966. It peaks here, back down again. So the market moves in cycles. It moves for a minimum number of years upwards, and then it's followed by a minimum number of years downwards. Okay. So this is the bear, The 1920, these are the bears. You can see here. Here's their length, their durations of. They all have 20 years here. This bear, the 1929 to 49 bear, had a 20-year duration. The 49 to 66 bull, 17 years. Here's your declines for the bears, your peaks for the bulls, and and so basically what you have is you make all your money during the bulls, and then you give it all back up during the bears. That's the way it works. That's the way it's worked. That's the way it'll always work because of human psychology. Okay. Here's the Dow Jones Industrials. Here you can see here, they're 1802 to 2001 here on this particular chart. But they have them. These are the, and here is the minimum 8 years. Here is a secular bull, the shortest secular bull since for the Dow since 1802 was 1921 to 1929. Okay, there were two. The shortest two secular bears were 1835 to 1843. You can see here in 1853 to 1861. And of course, these are the average returns for a bear. You're talking, an average of less than 1% a year if you're in the market, and a bull 15% a year. This here is the prior secular. These are now the other thing I think is important is this shows you here is that the highs for the bull that just ended 2022 will not be eclipsed till probably in the middle of the next decade. So probably 2035, maybe 2040, depending on how bad it gets, before the January 2022 high will be eclipsed. These are all of the bears that started and how long it took for the market to get back, even after the bull started to get back to its all-time high. We're talking 15, we're talking 25 years there, and we're talking, I think, 26 years there. Cyclical bulls are not to be confused, okay, with secular bulls are not to be confused with cyclical, okay. So you can see here, these are cyclical bulls within a secular bear, right here. These right here are two cyclical bulls. Same thing here. You have cyclical bears can occur during a secular bull. So they're completely two different animals, and most people don't know that. Okay. So right now here's the secular bulls and bears. Another look at it. So you can see 85, 50% decline, 47% decline, and here's all the gains. So make no mistake about it. The market, based upon all the past secular and history and human nature and psychology, it's going to go down by a minimum of 47% from the January 2022 high.
Okay, got it.
Are you familiar with the secular markets, Kerry?
Oh, sure. Yeah, I've studied them pretty extensively, but you lay it out very well there. Yeah.
And so the point is, it's inevitable. And there's some reasons. What happens is it's all has to do with investor psychology. So what happens is when a market goes up, so we understand after a market bottoms and goes up it's gone down for 8 years in a row and bottoms, and it goes up for the second year, people become more optimistic. And when it then goes up for the third year, they become more optimistic. So they put more in. They continue, as the market continues to go back up, they continue to put more in. That's just human nature. and they continue to take more risk. So it's the bull market, the secular markets condition an investor to either be fearful, the bear, to be the fear of the market, or the bull to be greedy. Okay, and that's just the way it works, and it's always going to work that way. And it started that way since 1803, and that's just the way it is. And we're in a down cycle. There's no getting around. What?
Human nature never changes, right?
Right. So we're in a down cycle right now. So so that's inevitable that we're going to see a decline. And we're going to see that decline for the market. Okay, and that decline, okay, is
So, Mike, during the Depression, nobody was really following cash flow. I guess back then, accounting rules were such that cash flow pretty much equaled profits, right?
I'm not sure what they looked at back then, what they were measuring, in financial statements back then. It was rudimentary income statement.
Yeah, Benjamin.
But I look at the cash flow statement.
Mm-hmm.
The cash flow statement, and so this is 3 ways to die for 45%. So we talked about the secular bear market. The other 2 are, you brought up a good point there, operating cash flow. And that's actually how I started with the whole interview, showing you that it's the operating cash flow that basically I use to predict the demise of Lehman, Bear Stearns, Goldman Sachs. I mean, the collapses, Merrill Lynch, of these brokers.
Mm-hmm.
Right?
Got it. Yeah, sure. Makes sense.
So, it's, people need to be aware of this. Now, how long have we been on now?
About 22 minutes or so.
Do you want to stop with this one?
And hey, just give us a little more illustration and why you think it's impending, why you think it's right around the corner.
Okay. Well, actually, okay. Let me. So what happened is that, and this is another. What happened is I predicted that in December of 2021. You see it on my screen right now, right?
Yep, I see it right there.
Okay, I was at a family office club event speaking in December of 2021, and I said that the bull market would be over for the S&P 500 in January of 2022. I said the probability was 66% for that to happen. And why did I say 66%? The reason why is that I'd done my research, and I found that 2 of the 3 prior Dow Jones bull markets had peaked in January. So the Dow peaked in January 2000. The Dow peaked in January 66, and the Dow peaked in September 29. So I asked myself the question, Kerry, why is it the Dow peaks in January? Why does it have a tendency to peak in January? I bet you can answer that question.
Well, it's tax selling that takes place in December, the January effect, so the new year optimism and all that.
Well, you're close, but I'm saying to you in January peak, because what happens when you get to the top of a market, a secular bull, they always peak, or they peak the majority of the time in January, because most people want to hold on to their gains and pay the taxes they sell the securities in January, so they can delay the taxes until for another total tax year. So if you sell in January of 23, okay, you're not going to owe that money until April of 24, as opposed to if you sold in December of 22, okay, you'd owe the money in April of 23. Okay, so I'm saying to you, the market is driven by math, totally driven by math, and so there's and there's a lot of psychology here. I'll show you something else here that is more of my research. Yeah, I'll show you more of my research here. What am I doing? Okay, which is the greed accelerator. Okay. You see this? S&P 500 crashes and days to recover. Do you see that?
Click that. So it's on the screen. Click it so it's on the screen. Oh, okay. So right here.
This.
Okay, got it.
You say it's S&P 500 crashes and days to recover? Okay. So this is my research, and here's what I did on bulls, on secular bulls. What I found is in my work on secular bulls that a secular bull cannot peak until it's eclipsed, until it has what I call greed accelerators occur. So this secular bull, the secular bull that began in 1982 and ended in 2000, it hit an all-time high in July of 1998. Okay, it then declined by 19.3% by August of 1998 at a crash. And then what happened is within 90 days, it got back to the all-time high. So what that bull did is that conditioned people to become, dip buyers. Okay, everybody's heard about the dip buyers that occurred in the last couple of years, and driving the market, buying the dips. It's a big deal. Okay,
EFD they call it. You can put in the F whatever you think.
Right. So here's the deal here. So it took 90 days. So if you'd waited for a double-digit correction and bought the S&P, and 90 days later you would have been up, at least 10% to 20% on your money. Okay, depending on where you bought down here. That's not bad for a 90-day period. Okay, that's 40 to 80% return. Okay, so guess what happens? It does it again up here. It goes to the July 1999 all-time high, corrects again, down by 12.6% by October of 1999, creates another opportunity like this one. And so what happens is it then reaches that, it finally climbs back in 87 days back to the high. So it did the exact same thing it did on this one, 90 days. Okay, so it's really working now. People are really become greedy when they're looking for dips. They're licking their chops when they see
buying opportunity.
What?
It's a buying opportunity.
Right. So now everybody's happy. Comes up, we get to the March 2000 high. It corrects by 10%, 11% by April of 2000, and it climbs. It goes within 90 days. It's not even. In fact, this is the August high. I have a typo here. Within 90 days, it's only made it back to the August high. Not the March, it's August of 2000 is the high as it's gotten. And this is the 90-day period. So because it can't get back to that March high, everybody throws in the towel. And you can see here, here's 120, here's the 90-day period. This is the next look at that, and it just rolls over and continues to move lower and lower because it can't get back up there. So everybody who was using that strategy of buying down 10%, making your money back in 90 days, once it no longer worked, they all gave up, sold out, and they quit buying the dips.
Mm-hmm.
So then it goes down by 49%.
Right. So that's,
you know, by 2002. That's where we are with this market. Okay. Here's 2000. By the way, let's talk about this market. So it hit its high in January of 2018, reached its all-time high, fell by 10%, double-digit decline. 143 days later, it's back to the high. So this one established itself as a 10, you know, takes 143 days to make 10% on your money, which is about 20% a year. Okay. So it gets back up here in September to the high, then it crashes again. Now a double-digit crash, and guess what? 147 days, it's back to the all-time high. So you would have made double-digit returns, okay, on both of those in 2018 by at the top of this bull, okay. But this one went on, and it reached the high in February of 2022, all-time high, and it fell then by 34%. But guess what it did, Kerry? Look at this. It went back to 100 within 127 days. It went back to the high.
Wow.
Okay. Since then, I don't have the rest of it on here right now, but to just tell you what happened since then. Obviously, we know that it went to a substantially higher high in January of 2022. And but what happened is it did not recover in 127 or 147 days. It didn't get back to the high. So everybody's throwing in the towel, and this market is behaving like both I just showed you. Mm-hmm. Okay, both of those that crapped out went down by 40 some odd percent and 80 some odd percent. Okay. That's what's happened. It's inevitable. The market's going down. Okay. Here's 1928, 29. Here you see another 10% move down, back to the high in May of 28. This is from the high, June, from the May high. This is September of 28. And you can see it's back, makes it back up there. So it works in all bull markets until it doesn't. Here it comes over September 29, reached an all-time high, collapses by 10%, unable to get back to the high within the 61 days. So what does it do? It goes down 86%. Okay. Mm-hmm. It rolls over, and that's what's happened. So the point is that this market, the bull that began in 2009 and ended in January of 2022, is behaving as those other former bulls. I mean, bulls or the bears behaved after they took over for the prior bulls. So we're definitely in a bear market. That means that stock prices are going to not only go down by a minimum of 47%, but this bear market's not going to bottom. It's not going to be over until 8 years. That means 2030 at the earliest. So if you're a buy and holder in this market, you've got big problems. Go ahead.
You're going to get crushed. So can you play this? I mean, without being reckless, do you buy puts, S&P puts or leaps? What do you do to make money off of this to insulate your portfolio? And the other question is, when it really takes its hit, what's the dividend yield going to look like?
Well, that's a whole nother discussion. This is not about the dividend yield. Okay. We're still talking about the secular bear here.
Just as an aside.
Yeah, I'm saying to you, this is right arm, the dividend yield, another historical thing I've researched back to 1871. This secular bears are back to 1803, secular bulls and bears. But the dividend yield, which I've researched 1871, confirms that this market's going down a minimum of 69%. So it's right in line. So you have two major macro indicators saying this market's going to get crushed. Okay. And I think the presentation here, I might even be in the March. Okay. So what you want to do, okay, is you, now there's things you want to do. Okay. You know, what we do is we you know, this is what I call a crash protection strategy. You see my screen right now?
Yes.
Okay. So here's secular. Okay. So basically, what you want is you want a return of capital. You want to wake up in the morning and say, I want to make sure I've got my money for, you know, because when this thing bottoms out, there's going to be buying opportunities. I also do that too. I'll ring the bell when it hits the bottom, and there'll be unbelievable opportunities. So you want a return of capital strategy, and to deploy that strategy, you need broad diversification. You know, you need because broad diversification you do not need, because it doesn't protect you against crashes, recessions, and depressions.
Right.
So stock portfolios, mutual funds, retirement plans, when everything goes down, they go down too. You don't want your money in these things. Okay. You want your money to be in 2 to 5 year maturity government bonds, 50 to 80% minimum allocation. Okay. 50 to minimum and maximum allocations, long short hedge funds, and 20 to 40% in the long short hedge funds, and 10 to 20% in startup and early stage venture opportunities. And let me just mention this also. AlphaTac was founded, my website was founded to protect, to do all this, but we won't get into that right now. Now, I've noticed I've said treasury, you know, 2 to 5 year government bonds. Why do you want 50% of your money to 80% in those? Because what's going to happen, this crash is going to cause a worldwide, it's going to result into a worldwide depression. Okay. So you want to have your money in bonds of those countries that have a credit rating of AA or above. Okay. And you want short-term maturities of 5 years and less, okay, to reduce market risk. And you want the highest rated countries, because those countries are able to collect, they've demonstrated they've been able to collect their taxes to pay their debts during tough economic times. The United States is a good example, okay? The U.S. tax rate increased from 26% in 1929 to 80% in 1936. So the U.S. government can afford to do that because we're, you know, we're a democracy, and we pay our taxes. We pay our taxes. Okay. Now, because of that, because the tax rates, Carrie, are going up. Okay. Individual income tax rates are going up. So you want to allocate a good 10 to 20% of your capital into, you know, probability high for, you know, for tax rates to go up, and the long-term you want to plant the seed so you have long-term capital gains coming. Okay, because it's going to be at a lower tax rate. Mm-hmm. And so this is AlphaTac. Here's what we do: we provide these solutions for investors. We named it AlphaTac because we grow assets against the wind. So, you know, if you're a sailboat can sail all the way across the ocean with the wind blowing against it.
Okay.
Right?
So, Michael, question.
Yeah.
When do you anticipate the crash is going to occur? Is it going to be a summer crash or a September crash? What are you thinking?
It's going to be, they'll be in the third quarter. It'll be in the third quarter of this year. That'll be a significant crash.
So we have time. So third quarter, which is historic, September, October crashes.
Absolutely. It's a September, October crash.
Also, we've had a number of crashes recently in March as well, right?
No, but so the other thing is, so remember, I have algorithms that forecast and predict the markets.
Right.
Okay. I have one right now that's, I have one right now. I have it's called S&P Forecaster. And it generated a gain by trading the market long and short. It generated a gain of over 100% last year. Okay, by trading the S&P 500 long and short. So it's predicting the crash. This is the algorithm, and this actually predicts the S&P 500. It's very accurate at predicting the S&P 500's moves a year in advance. Okay, a year in advance. Very sophisticated algorithm. And the important, you want to definitely put your money in hedge funds, because the same algorithms we use to predict market crashes and bottoms can be used to trade the market. Makes sense, right, Kerry?
Of course. Yeah, makes total sense.
Yeah. I mean, look, here's a good example. Here's the Dow Jones 1929 to 32. Okay. If you had bought where all the longs, okay, there, if you'd bought it at the bottom of every trend and sold at the top, and then sold and shorted at the top, and bought back at the bottom throughout that whole period of time, you would have made a gain of 258% on the longs and 319% on the shorts, selling the market short. That's cumulative 577%. If you just bought and held the market, you'd be down 85%.
Can an ordinary investor actually do that, Michael? Is that possible, really?
Yes, you can do it through hedge funds. Okay, and that's what we do at AlphaTac. We introduce investors to hedge funds that use our algorithms and do this. Okay, you can't do this without an algorithm or a system.
Gotcha.
Okay, a guy can't wake up in the morning and figure out how to trade. That has no experience, no computer systems. We're talking deep data mining here on doing this. So yeah, it's very rare. It's probably somebody was unable to. I doubt anybody was able to do it in 1929 and 1932. But the bottom line is they could have done it here. And this is the NASDAQ, same thing. You can see the.
All right.
You got it. What?
So we got to wrap up now, but the site is alphatac, TACK.com. And TACK.com. TACK.com. And hey, if you've got a question for Michael and myself, shoot me an email, kl@kerrylutz.com. Be a link in the show notes to this interview, take you right to AlphaTac so you can check it out. And while you're there, sign up for your free newsletter. Michael, appreciate you coming on. I'm looking forward to parts 2 and 3. We'll try to space them out approximately 2 weeks apart. Michael, thanks for stopping by. Be well.
Thank you, Kerry.